Have you ever wondered how big companies forecast their sales? Or how economists predict where the economy is heading? Well, it's not a crystal ball. It's really more like being a data detective. You're looking for clues hidden in the past to try and map out the future. So today, we are opening the case file on time series analysis to figure out how it's done.
And that really is the big question, isn't it? Can we look at the rhythm of things that have already happened and get a real, reliable glimpse of what's coming next? Let's find out. Okay, so right away you see the core challenge. Take a look at the left. That's the Swiss franc to US dollar exchange rate. It looks like a total mess, right? It's all over the place. But then on the right, you have monthly US retail sales. And that tells a completely different story. You can see a clear pattern, a steady climb with these regular little spikes. The very first job of a data detective is to figure out how to separate a real pattern from just random noise. To do that, to tell the difference between a pattern and noise, we have to understand our main clue. And that's data that has a memory. This is what we call time series data. And it's really simple when you break it down. It's just a bunch of observations that are recorded in a specific order over time. Now, that word order, that's the whole key. You can't just shuffle this data around. What happened in January directly affects what happens in February. Each data point kind of remembers what came before it. And that memory, that's the key we're going to use to try and unlock the future.
So, where do we even begin our investigation? Well, we start with the most basic technique in the book. We are literally just going to try drawing a line through time. And to do that, let's open up our case file, Starbucks quarterly sales all the way from 2001 to 2017. I mean, you just glance at this evidence and the story's pretty obvious, right? Sales are going up. There's a really strong upward trend. So our job is to try and model this trend so we can make a decent prediction about where it's going to go next.
Okay, our first suspect is the simplest tool we've got, the linear trend model. All this thing does is draw the best possible straight line it can right through all those data points. The huge assumption here is that Starbucks sales go up by a constant dollar amount every single quarter. So, for example, it might think sales go up by, say, $80 million each quarter, just like clockwork. Seems reasonable, but is it right? And here's where we get our first plot twist. Because, the simplest tool, it isn't always the right one. And sometimes these simple trend lines, they lie. You have to remember, every model makes mistakes. There's always a little gap between the prediction and what actually happened. We call these mistakes residuals. And here's the first rule of being a good data detective. For a model to be any good, its mistakes have to be completely random. They should look like static on an old TV. No pattern, no rhyme or reason. And this is the smoking gun. This chart shows our simple model's mistakes, and that is not random static. Not even close. You can see a clear U-shaped pattern. The model was consistently wrong in a predictable way. It underpredicted, then it overpredicted, then it underpredicted again. A pattern in the mistakes is a dead giveaway that your theory, your model, is fundamentally wrong. So if assuming a constant dollar increase is the wrong theory of the crime, what's the right one? Well, this leads us to a much smarter approach, modeling constant growth. So here's the difference, and it's a big one. Our busted linear model on the left assumed growth was a fixed dollar amount, like adding $80 million every quarter. The log linear model on the right makes a much more realistic assumption, especially for a growing company. It assumes sales increase by a constant percentage each quarter. Think about it. Growing by 3% every quarter is totally different than growing by a fixed 80 million, especially as the company gets way bigger. This is exponential growth. And just look what happens when we use this new theory. This chart shows the natural log of the sales, which is just a mathematical trick to focus on that percentage change. And wow, that curve we saw before, it completely straightens out. This is data that a simple straight line can actually describe. We finally found a model that fits the evidence. And the proof is right here in the numbers. This new log linear model, it can explain 97.7% of the variation in Starbucks' sales. Now, in the world of data analysis, that is an absolutely fantastic fit. It's a slam dunk. Case closed on which model we should be using. But just when we think we've cracked the case, a much bigger, much trickier challenge shows up. It's a fundamental problem with a lot of time series data, and we call it the randomness problem. Okay, I'm going to throw a technical term at you, covariance stationary. Just think of it like a river. A stationary series is like a nice, calm river. It's flowing predictably, its average level isn't changing, and its choppiness, its variance, stays about the same. But our Starbucks data, with that big upward trend, that's like a river during a flood. Its average level is constantly rising. So why does this matter? Well, because most of our best statistical tools are built for the calm river, not the flood. If you use them on data that isn't stationary, you can get results that are complete and utter nonsense.
For example, look at the sales for AstraZeneca on the left. Clearly not stationary, right? It's got that strong upward trend. But what if instead of plotting the sales, we just plot the change in sales from one quarter to the next? Well, you get the chart on the right, which just looks like random noise. It's stable. By doing something called differencing, we've basically tamed the data and made it ready for some proper analysis. And this brings us to the data detective's greatest enemy, the most famous, the most unpredictable type of time series there is, the random walk. Imagine a perfectly efficient stock market. In a true random walk, the next step you take is completely, totally random. It has no memory of where it's been. And this leads to a really mind-bending conclusion. For a random walk, the entire history of the data is completely useless for predicting what happens next. The absolute best forecast you can make for tomorrow is just whatever the value is today. That's it.
Okay, so we've navigated trends, we've looked at the mistakes, we've even faced down a random walk. Now let's just close the case file and recap the key steps for reading the clues in your own data.
Here's your 4-step detective checklist. 1. Always just look at your data first. Get a feel for the pattern. 2. Choose the model that actually fits that pattern. Is it linear or is it exponential growth? 3. You absolutely have to check for stationarity and fix it if you need to. And 4. The golden rule. Always investigate your model's mistakes. They have to be random, no excuses.
So if you only take away a few things, make it these. A simple straight line can easily fool you. The most important clues are often hiding in the patterns of your model's mistakes. Remember that real-world growth is usually a story about percentages, not fixed dollar amounts. And finally, you have to wrangle your data and check for stationarity before you can really trust what your models are telling you.
And that leaves us with the one big question that every data detective, every analyst has to face every single day. We are surrounded by these endless streams of data. And the hardest part isn't just finding patterns, because there are patterns everywhere. The real challenge is having the wisdom and the right tools to figure out which of those patterns are real, meaningful signals, and which are just ghosts in the machine, nothing more than random noise.